Hey guys, David Robinson here. Welcome to the apartment investing journey. Excited about our guest today. This individual is someone that has a really cool story that I think will resonate with a lot of you. He made a big jump from where he was to diving headlong into large apartment acquisitions. And I'm excited to talk about his story, where he was and where he's at today, and managing an asset that he took down prior to all the chaos that's going on here with COVID-19. So without further ado, KyleMitchell, welcome to the show, man. I appreciate you coming on.
Yeah, David, thanks for having me on. I'm excited to be here.
So a little bit about Kyle. He's a real estate entrepreneur who has a focus on multifamily syndication and currently has $17 million worth of real estate under management. He's the managing partner and co-founder of APT Capital Group. Their mission is to positively impact the lives of the investors and the communities which they invest through the highest level of transparency and fiduciary responsibility. Kyle is also the co-host of a weekly real estate podcast, Passive Income Through Multifamily Real Estate, which I listen to all the time. He speaks with various experts in the real estate industry to help them educate and create clarity for passive investors. With a background in operations, management, and logistics, he has overseen multi-million-dollar businesses and has a passion in doing the same in the multifamily syndication space. So that's a brief synopsis of your story, but as many of our listeners know, our podcast is all about getting the journey. And so if you don't mind, Kyle, let's back up. Talk to us about what you were doing before you got into real estate, a little bit about your background, and how you made the transition into real estate.
Yeah, absolutely. And again, thanks for having me on. So in my previous career, I was in the golf business. I grew up playing golf, fell in love with golf. As I was growing up, I was probably playing 7 or 8 different sports. And as soon as I found the game of golf, I think it was in 7th grade, I completely dropped everything and played golf full time basically from there on. Played golf through high school, a little bit in college, but my journey in the golf business began in high school as a high school job. I tried to go pro when I was playing golf, and I found out very quickly that it's easier said than done. You know, I was using my parents' money to sponsor me, and I tried for quite a while, and it's just really tough to make it on that circuit. And I didn't have the mindset at that time actually to make it. And so I naturally just fell back into the golf world as far as working at a golf course. And my plan was to go back to school and get a business degree and then kind of see where it took me from there. And I got a promotion at the golf course. And then 6 months later, I got another promotion. And a year later, I got another promotion. And then by the time I knew it, I was one of the youngest general managers hired by the company and at my 3rd golf course, and school was an afterthought at that point. Looking back, yeah, I wish I would have went to school, but at the same time, I learned through the school of hard knocks by doing it. And so I was in the golf business for, 16, 17 years as a general manager and as a regional manager. So managing people, building systems, hiring, firing, and learning how to run and operate businesses, which is what we do today in our apartment business. I worked for a property management company, but for golf courses. So that was, all the way up until about 2010. And that's when I started investing in real estate. Now I worked for golf all the way up till about 2018. But I first found real estate in 2010 when I did a house hack. I bought my first house. And at that point, houses were pretty cheap coming off the crash. And I moved 2 of my friends in. And, I put money into the property as we lived in it. And at that point, the light bulb went off for me. It made sense. My friends were paying my mortgage, and really all I had was the bills for my utilities, and that was it. So I was living for very cheap. But at that point, I didn't really invest in real estate again until 2013. At that point, I was educating myself a little bit more, trying to find ways to put my money to work. I did not want to go into the stock market. I had a bad experience when I was in high school. In high school, I had $2,000, and at that time, $2,000 was quite a lot of money. I'd saved it up, and I heard one of these golfers just talking about a tip that he got, and I fell into that trap. And 2 months later, my money was gone, and I was like, "What is going on here?" I had zero control over it. And so the stock market was something that was just, a bad taste in my mouth. So I wanted to look for other things. Real estate just naturally came to me. So at that point, I got my real estate license because I just wanted to learn more. I started investing in single family turnkey homes. And that was because I was working 70, 80, 90 hours a week at my golf job. So I just wanted some passive income. So I started purchasing single family turnkeys there for a few years, and I quickly realized it was tough to scale. You know, you're limited to the amount of loans you get for residential loans. I would need 100 to 200 to 300 of these single family homes in order to get to the point where, you know, I could leave my full-time job and passively cash flow off these properties. So I thought, you know, let's stop doing this. Let's look for a better way. And at that time in my career, I was actually really just burnt out on the golf business. Again, I was working at a golf course that was requiring 80 plus hours a week on my time. I was driving 45 minutes to an hour each way. So it was really beating me down. And so I started looking for another career path at the same time. And naturally, real estate made sense. Like I said, I had my real estate license. I really enjoyed real estate. I understood real estate. And so I happened to stumble upon some online courses for multifamily. And I took one with my girlfriend at the time, my wife now, and I fell in love with the business model, you know, because it's exactly what we do at the golf course. It's driving income, controlling expenses, building systems to be more efficient, hiring, firing, managing people, and really just creating an efficient business. And so I fell in love with it. 11 months later, I ended up quitting my job. Before we had even gotten started, or not gotten started, we had built our business, but had gotten our first deal. I left my job to pursue this full time, and now it's been about 2.5 years since we created the company, and just over 1.5 years since I left my job full time.
Wow. Cool story. I want to back up just a little bit and maybe talk about that time frame in 2013. You touched on this. So if I understand your timeline correctly, you bought the single family property that you house hacked in 2010. You didn't buy anything else until 2013, where you started buying single family turnkeys. Is that correct?
Yeah, and what I didn't mention is I didn't really have the capital there. I put it all into my single family, and then I started listening to podcasts, and the light bulb went off. Is, you know, your single family home is actually a liability. It's not an asset. It wasn't creating passive income. Yes, I was collecting some rent from my friends, but at the same time, it was more of a liability. So I actually decided to sell my single family home, take all the equity out, and that's when I started buying single family homes in turnkey single family homes in 2013.
Okay. And what markets were you buying in? Like Midwest? Is that where you were?
Yeah, Midwest. Now, one other thing I did skip over too is I did buy. I apologize. I totally forgot about this house. It's probably because it was a nightmare of a house. I did buy another single family rental in Southern California, and that only lasted about 6 months. And that's the first one I bought in 2013. And I learned quickly you want to buy in landlord-friendly states. I had a professional tenant come in, and if anyone doesn't know what that is, they basically know how to play the system. So he paid 1 month's rent, and then he stopped, and I was trying to do everything myself. I was a realtor on the deal. I was also the landlord, and I was managing the property. And I didn't know that if you owe $1,000 in rent or $2,000 in California, and they paid you $50 towards the rent, you have to start the eviction process all over, even if it's $1 towards the rent. So I was 3 months into an eviction. He paid me $150. I took it, and I didn't realize I had to start the process all over. So long story short,
wow.
I got them out, sold the house at about a break even, maybe a slight profit. And that's what really triggered me to go out of state. And the first state I bought in was Arkansas, which is one of the most landlord-friendly states in the United States. And that was my game plan. And I did not follow my game plan after those couple of purchases. Those properties have done really well for me. And that's one of the reasons, is because it's, you know, you can evict someone after 5 days. And so it's a very strict law, and people tend to pay their rent on time. So then, you know, I wanted a little bit more cash flow at that time. And so I started chasing cash flow, and I forgot my rules of real estate investing, which is something that you should never do. And my one rule was to buy in landlord-friendly states. And so I bought in Chicago, and the cash flows were phenomenal. I mean, I'm cash flowing in Arkansas probably $200 a door. In Chicago, I was cash flowing $800 a door.
Wow.
And so immediately I was like, oh, this is a gold mine. Let's go there. Let's go there. And the first 12 months was fantastic. And the next probably 2 years now have been a absolute nightmare, and happy to share on that kind of stuff. But it's because it's not a landlord friendly state. It takes 60 to 90 days to get someone out. Costs a lot of money to get them out. I should have fired my property management company a little bit quicker than I did. So I dealt with those for a few years, and that is when I got into multifamily after that.
Okay, so let's talk about that transition then. Help us. You touched on this a little bit, maybe dive a little bit deeper into. Okay, you have these challenges with the single families, with the turnkey deals in Arkansas and Chicago. You have one that's cash flowing great, but having troubles with the tenants and the tenant laws in Chicago. When was it that your mind was opened up to multifamily? And if you can go back to that point in time, if there was a moment, or if there was something that you heard or learned, or I think you mentioned a course that you had bought. Talk to us about that process.
Yeah, really what happened was I purchased 9 of these turnkey properties, and I also bought in Ohio. So I had 3 different markets going on, and that was my plan. And when I looked up, I was about to hit my 10th loan. And really when you hit your 10th loan, you got to go into commercial. And the leverage is less. And so the numbers didn't quite work out as I wanted to. So I thought to myself, what else am I going to do to continue to build my portfolio? And so that's when I started looking around at different things. And that's when I just started Googling and listening to more podcasts, and found multifamily. And I saw the course, looked interesting. It was pretty cheap. I finished it in about 3 weeks, and that's when I fell in love with it. And I just went full bore multifamily from there on out.
Okay. And what is it for those I'm sure there's listeners right now that are in a very similar spot to you. They've acquired a few either single family or small multifamily properties. Maybe they're cash flowing well, or maybe just, cash flowing a little bit. And they've realized that they're starting to get to a place where they're going to hit a wall, whether it be the financing restrictions, or whether it just be a point where they realize, my goodness, this is going to take me a long time to reach where I want to reach. So what was it about multifamily that intrigued you?
Yeah, multiple things. The scale of it, number one, the ability to really be able to be part of a team. Single family is very singular, right? And I love multifamily because it has multiple revenue lines. It has multiple expense lines. And so there's more control over that as well. And it just spoke to me. My background is in that, managing P&Ls, managing a business. Single family homes you can do by yourself. It's not really quote unquote business, although, some people would argue they certainly run businesses off of single family homes. But one single family home itself is not a business, in my opinion. And one multifamily property, depending on how large it is certainly a business. And there's more flexibility. You can be more creative with multifamily. And again, it doesn't mean you can't make money in single family. I know several people who make, millions of dollars in single family. So I'm not saying one is better than the other. Multifamily just speaks to me. It speaks to my background, my training, and what I do.
Okay, great. So talk to us about the process then. So your mind is triggered, and you say, all right, this is a great path. This is up my alley. This fits into the background that I've had in business in the past. How do you attack this? How does one go from, hey, this is a great idea, I like this, to actually executing?
Yeah, I'm fortunate enough to have found that course as my first introduction to multifamily. And that course was kind of a step-by-step process on how to get started. And I'm a very systems-driven person. I was at an event and they called me an implementer, which, I thought about that and I'm like, oh yeah, that's actually right. I model after others. It's not like I steal their ideas, but even Tony Robbins says it, you don't want to recreate the wheel. Model after what other people are doing in the space that are successful. And so you don't have to go through the same pains. And so that's what I did. I looked at the most successful people in the industry and I started building systems out based on some of those things. And I also followed the step-by-step guide in that course, but we just dove head first. My girlfriend, again, at the time, I think we were recently engaged. And so we got on the same page with one another and I dove right in, and she was with me the whole way. And, we started building our email list, our monthly newsletters, we started a meetup, and then it gradually turned into where we are today with, one podcast, 3 different meetups in 2 different markets, a couple of properties in those markets, and a bunch of other things to come.
Oh, that's great. Um, so during that time, you were still working full time at the golf course. Is that correct? When did you stop working at the golf course and then devote all of your time to multifamily investing?
Yeah, about 11 months in, and rewinding a little bit, I didn't do it unplanned. I had been looking for a career change for about 3 years. So I had been saving up a nest egg, planning on being able to afford not having income for well over a year. And so those things happened, well before I left. It just happened. I was looking for the vehicle. And as soon as I found the vehicle, I knew, okay, the only thing I need to do now is set up my business to the point where we're ready to go. And so that's really what those 11 months were for. It was, setting up the meetup, building our network, educating ourselves, building our investor list, picking our market, going out there and establishing relationships in those markets. And when we got to the point where we started making serious offers, I knew it was only a matter of time until we closed on a property. And, in multifamily, I mentioned building a team. Depending on what part of the team you are, you can certainly have a full-time job and still manage and or be in multifamily. But in my world, I'm a lead operator, a lead sponsor, an asset manager. And that's something that takes a lot more time and energy than, let's say, raising capital or finding a deal or underwriting a deal. I'm always involved in the property. And so I knew at a certain point I'd have to leave my job. And so like I said, when we were making offers, I decided to leave. And 2 months later is when we got our first property.
Okay, cool. Well, we are going to do a deal dig segment on the 128 unit deal that you took down in Phoenix, but I want to talk about your first deal, which I believe is different than that one, correct?
That is correct.
Okay. So maybe if you can, let's just talk about that process of you buying your very first apartment building.
Yes.
Walk us through it.
Yeah. So I think, a lot of people ask, how were you able to be a lead sponsor on your first deal? And I have several mentors in the multifamily space, whether it be through books, podcasts, or meeting them one-on-one or doing coaching with them. And the number one thing was get out of your comfort zone and do what others are not willing to do. And that is what separated us and allowed us to get our first deal. So my wife and I were driving while we had our full-time jobs. We would take one weekday off. It was our only day off in the week. And we would drive to Tucson, which is an 8-hour drive. We would leave at 2:30 in the morning, get there around 9:30 in the morning. And a couple of days before that, I was calling brokers, letting them know, hey, I'm going to be out there. We're going to be with our property management company. We'd like to tour what you have. And so we did that once a month for several months. And on one of those drives, it was probably 9 in the morning. I got a call from one of the brokers that I was going to meet at another property. And he said, hey, I just got this listing, just got signed over to me. I haven't even walked the units. Do you want to see this property since you're going to be in town? So some people can say that's luck, which certainly played into it. But if I wasn't driving out that day, it would have never happened. So we were literally the first investors to see the property. And our property management company happened to be touring with us that day. So they got to see it. And since we were in the area, we also got to tour the comps that day. So we did a lot of quote unquote due diligence on the property before, the broker had even basically seen the inside of the units. And we liked the property. We liked a lot of things about it. The first thing I noticed was the phone number on the side of on the sign was not right. It was disconnected. So I'm thinking, man, how are people leasing up here? They have a single family home property management company running it. So it was really being run inefficiently. And so we really liked the property. About 3 weeks later, we had it under contract. And that's how we got our first deal. And like I said, it goes back to doing things that others are not willing to do. Not many people are going to drive 8 hours in the middle of the night, on their only day off to do that. And we wouldn't come back until the next day at like 12 or 1 in the morning and then go to work the following day.
Man. Yeah, that is impressive. So if you don't mind, you live in California. The first property that you bought, I believe, was in Tucson. And you've also acquired another large building, 128 units in Phoenix, which we'll cover here in a minute. What is it about the Phoenix market? Why did you choose the Phoenix market? What are you looking for in property that, what's your buying criteria? What is it that you're looking for? And what is it that you like about the Phoenix Tucson market?
Yeah, so one mistake I will never make again is I will always buy in a landlord-friendly state. So I learned my lesson, and so that's one of the things about a market, right? job friendly, pro-business. Now, all the other metrics, rent growth, job growth, population growth, net migration, and job diversity, which I think is a huge one for me. And if you look back in 2008, you would say Phoenix was actually not very well diversified, very heavily reliant on construction jobs. They've done a nice job over the last 12 years of diversifying that job front. And that's one of the things that we really like. And Tucson does lag Phoenix, but I like Tucson as well. And for the same reasons, they led the nation in rent growth, in net migration, population growth. All those metrics are what make up a good market. And Phoenix and Tucson certainly have all those metrics along with it.
That's great. Well, Kyle, you have a great story, and you're obviously a guy that's just, once you have something in your mind, you're going to go full bore into it. I love the story about you and your now wife driving 8 hours to go and scope things out and really just hustle until you found a deal and show brokers that you were serious about what you were trying to accomplish. And it's not like you just did this on a whim. You'd been setting a foundation for 11 months before you actually acquired this property. And you'd put in a lot of work after hours, I'm assuming, while you're currently working a full-time job at the golf course and setting the foundation so that you could be successful as you moved into that acquisition.
Yeah, you've got to find dead time. Just because you have a full-time job doesn't mean you can't fit it in. I mean, I said earlier I was driving 45 minutes to an hour each way to work. So that's an hour and a half minimum each day that I'm driving. Well, I'm either educating myself on podcasts, or I'm calling brokers, or I'm talking to other investors. So, I utilize that time for things like that. But yeah, if we would have gotten a deal 6 months earlier, we wouldn't have been ready. We were building our email list and our investor database for a year before we got our first deal. And I'm thankful looking back now that we did that, because we really wouldn't have been able to raise the funds for our first deal if we would have done it within 4 months. Now, that doesn't mean no one else could do that, or there's not other avenues that you can take. But, again, looking back, I'm glad that we did it the way we did.
Yeah, that's great. Well, I want to go into our deal dig segment and cover this 128 unit Class C value add deal in Phoenix, if you don't mind.
Let's do it.
So if you could just talk to us a little bit about the asset itself. I gave a brief description, but if you can, just describe the asset itself, and then let's talk about how you actually source the deal.
Yeah, 128 unit property, $15 million deal in East Phoenix. And we like that area because you're starting to see a lot of overflow come from the Scottsdale and Tempe areas where they're getting overpriced and they're flowing into this area. So it's definitely a Class C area that is slowly gentrifying, and we're hopeful that it will be into a Class B area soon. They've got some new build stuff going in, brand new school across the street. But this property, we found it almost the same way as the first property. Our other partner got a call from a broker and said, hey, we've got this listing. And this is one of the guys I partnered with on our first deal. And he said, hey, Kyle, I don't have time to underwrite this. I have a full-time job. Can you take a look? I underwrote it that day. The next day, me and my other partner were in Phoenix. We drove 5 hours. We left at 4 a.m. We toured it. And the first day it went to market, we had it under contract. And so there was no bidding war. There was no driving the price up. And the things that we liked about the property was, it had meat left on the bone. Certainly the property had come a long ways from the previous owner. They had it for about 5 years, but the market was so good in Phoenix over the last 5 years that you didn't have to really add too much value to it. So they only put money into about 20 of the 128 units. So there's 108 units still that are in classic condition. Exteriors looked good, but could be better. You can add some amenities, and rents were well under market. And so they also had a property management company that does multifamily, but that focuses on smaller multifamily. They're usually going 50 units and under. So their systems were not in place, their processes were not in place, and there was money falling through the cracks, certainly. And so those are some of the things that we liked about the property.
Yeah, that's great. I'm curious if you ended up using the same property management company that you used in the Tucson deal for the Phoenix deal.
We did, and we absolutely love them, and that relationship is continuing to build and grow, and we really like them because of the flexibility, because they work in both markets. But we have been extremely successful on the Tucson property and really liked the systems that this property management company has in place and the leverage that they can use because they're such a large company. So we did end up using them as well, and we've been very happy.
Okay, great. So you mentioned it was roughly a $15 million acquisition. If you can, maybe just describe to us how you financed the deal.
Yeah, so it's a Fannie Mae green program loan, which at that time made sense. I think it probably is one of the last loans that made sense under the green program, which is basically an energy savings program, putting in low flow toilets, LED lighting, just green efficient fixtures to lower the cost of the utilities. So not only does it help out the product or property in the bottom line, but it's a green program. And so with that green program, you get a discount on the interest rate. Again, they're not focused as much as they are on that green program now. Fannie Mae is not. You get more of a discount for things like affordability and things like that. So those do change over time, but at that time we got about a 40 basis point discount on our interest rate. So it made sense. The cost to do something like that is going to cost us about $40,000, and it's going to bring money to the bottom line as well. So we did that, a 10-year term, and we worked through the same lender that we worked with on our first deal. And it's all about relationships in this business. And so we're just establishing that relationship even more, and they were able to get us to the finish line.
Yeah, that's great. And then how did you structure things with your investors?
Yeah, so typically, without getting too far into it, we structure with an 8-pref, 70-30 split is our general rule of thumb. And from there, there's a 1% acquisition fee, and we don't do a disposition or a refinance fee. And then it's a 2% asset management fee.
That's great. What's your plan with it?
Plan is to hold for 5 years, typical syndication model. And it's going to take about 18 months, maybe a little bit longer now that we're in this COVID-19 situation, because we have halted all major renovations. We did get caught a little bit in the turnover of the residents. The resident base is certainly something that we want to, get a better resident base in there. And right now there's no evictions for 4 months, and we've only had the property for about 6 months. The plan was to slowly get them out as they turned over leases, about 6 to 8 a month. So that would take about 18 months to fully stabilize. I anticipate it probably taking 24 to 30 months now. But the goal is to get it stabilized. From there, take a look at where we're at. It's all about the velocity of money, really, when you're doing syndications and investing in real estate. And so if we can get out of it earlier at a price that we like, then we can put our investors' money to better work. Then that's what we'll do. But generally speaking, we'll do a 5-year hold, 18 to 24 months on the rehabs, then stabilize the cash flows, and then look to sell it at that point.
And did you mention that you had started some of the capital improvements and then you've halted all capital improvements at this point?
Yeah, our model is one that on day one, we start the work. We don't wait for much. So the first thing that we like to focus on is exterior renovations to show the current resident base, hey, we are putting money back into the property. We're making this a safer, cleaner, better place to live. We did that at our 42 unit and it worked great. Most of the residents ended up staying in that situation. So you really want to put money back into what most people can see, not just the interiors, because only new residents are going to really see the interiors. So we started on that. So most of our work on the exteriors has been complete. We've got a couple other things that we're working on that we've halted for now. And then the biggest thing that we've halted is the interior upgraded renovations. We're still doing in-house turns and things like that and small things. But as far as the full business plan, which is to add washers and dryers, new cabinets, flooring, things like that, that's been on halt right now. The biggest thing that we're focused on is maintaining occupancy.
That's great. That's great. So let's, if you can, well, before we dive into our last 3 questions, one final question I have for you. What's the biggest challenge you're facing right now as we go through the COVID-19 on the asset management side?
Yeah, I think it's with the 128 unit is just being able to balance, the current tenant base, which is certainly one we want to turn over, and getting rent collections and maintaining occupancy. You've got to be really careful with that. So far, through April, and I'm sure when this is going to air, we've collected 90% of our rents in Class C. I think that's pretty good. We're happy with that number. But I'm I'm worried about May, June, and July. And I'm not just worried about our property in May, June, and July. I'm worried about all Class C product and even Class B at that point, to see what really happens. It really depends on how much more stimulus is going to be pumped into the economy and how quickly some of these markets can open up. But, we're in California right now, and even though some things are opening up, we're being told that they can only operate at 25% capacity. My wife is the general manager of a golf course, and that's what she's being told. And so at 25% capacity, that's not going to solve the problem. You're just kicking the can down the road. And, whether that's the right thing or the wrong thing to do, it is what it is. And so I do think the next 3 months are going to be the biggest challenge. And we're just trying to work with our residents and be as proactive as possible and really peel back the onion. I'll give another quick example if we have
Please.
time. On our 42 unit property, a lot of people right now are saying, oh, our collections versus last month are great. I'm going to give you an example. Our 42 unit property, we collected 108% of the income that we did in March. And if I would have stopped right there, I would say, oh man, we're in great shape. There's nothing wrong. Tucson's not affected by this thing. We're kicking butt. But you've got to peel back the onion when you look at this, and that's part of asset management. We had 4 move-ins at the very end of March, and so our collections are going to be higher in April because we have a full month's rent being 100% occupied. And then the other thing is that we still have 4 residents that have not paid rent, so we're actually 90% collected. There's just other fees like security deposits and other income and other things, lease termination fee that we collected that allowed that income to be greater. So on one end, you're looking at something that says I'm at 108% collected, but what percentage of your residents today versus last month were paid? That's the better question in this situation. And so we're at 90% or 91%. Those are 2 completely different stories. And so, now we're looking at, okay, let's work with these 4 residents. What else can we do? What is next month going to look like? Where if you looked at just the 108%, you may not even be worried, which is a huge mistake.
Yeah, that's a great example. Thanks for going into that.
Yep.
Well, Kyle, man, you've been gracious with your time. I appreciate you walking us through your story and your journey, and also this specific deal, the 128 unit in Phoenix. I want to start winding down here, but I got 3 final questions I want to ask you. Okay with that?
Let's do it.
All right. What's the biggest mistake you've made on your real estate investing journey so far?
Yeah, I mentioned it earlier, which is not following my rules of real estate investing. I have those rules for a reason. I've written them down, and number 1 rule is invest in landlord-friendly states. And so when I went for the cash flow as opposed to looking at the market first, and I bought my houses in Chicago, that was a big mistake.
Great example. What's the biggest win you've had on your apartment investing journey so far?
Yeah, we're still early in our career. We only have 2 properties, but I think the biggest win is the team that has been able to be built by doing these deals together with everyone. We have the same partners on our 2 deals, and the relationships have been fantastic, and that is allowing us to set ourselves up to scale and move forward. If it's property specific, it's our 42 unit. It's done really well. We actually listed it on the property already, or on the market already, just less than having it less than a year at a price above of what we projected in year 6. Now, whether that sells or not because of all the whole COVID-19 situation, that property's positioned very well.
Oh, wow. Yeah, that'd be great. And the last question I have for you is, what's the best advice you have for someone who's just starting their apartment investing journey?
Be consistent, or get out of your comfort zone. But really, it comes down to being consistent. The reason why we've been able to be successful is because other people are not consistent. If you want to separate yourself, consistency is key. I mean, our newsletters go out the same day and time every month. Our investor communication, same day and time every month. Our meetups, same day and time. Podcast, same thing. Don't do something unless you're going to fully commit and be consistent with it.
Love it. Well, Kyle, how can our listeners connect with you, learn more about what you have going on, and explore any opportunities you have coming up in the future?
Yeah, I appreciate that. 2 ways. Podcast is passive income through multifamily real estate. We just added a Friday episode, which is focused on asset management. So if you're more on the active side, check that one out. Our passive income one airs on Mondays. And then also aptcapitalgroup.com. We've got a free passive investors guide for anyone that wants to take advantage of that.
Okay, love it. And we'll have all that in the show notes. Kyle, again, thank you so much for taking the time. Appreciate you sharing your journey with us, and look forward to connecting with you again soon.
Definitely. Thanks for having me on.